Welcome to Beyond the Pages podcast, because the right book can change everything. Today, we're diving deep into Morgan Housel's The Psychology of Money. This book really flips the script on how we think about wealth, doesn't it?
It absolutely does. What's so interesting about Housel's approach is that he moves away from pure financial theory and dives into the often overlooked psychology of money.
So instead of number crunching, we're talking about the minds of those who succeed and those who don't. I'm ready to unpack this.
Well, Housel kicks things off with this story about a brilliant but broke executive. This guy was so successful, he used to carry bricks of $500 bills. But one day he gets into it with a hotel manager over a broken lamp.
It sounds like trouble.
It was. Instead of just paying, he throws thousands of dollars at the manager. His message was clear. Don't you ever imply I can't afford something. But this impulsive act foreshadowed his financial downfall.
So are you saying that even brilliant minds can make terrible financial decisions because of their behavior?
Exactly. Then Housel contrasts this story with Ronald Reed, a janitor and gas station attendant who quietly amassed an $8 million fortune.
Wait, a janitor turned multi-millionaire? How is that even possible?
Through patience and smart investing, it's a classic tortoise and hare situation. Ronald Reed was in it for the long haul. Housel uses these stories to show how our personal experiences shape our financial views, often more powerfully than formal education.
It's not just what we know, but how our past experiences influence how we act with money. Like, if you grew up struggling, maybe you're quicker to grab a lottery ticket. That chance at a big win could feel like the only way out.
That's exactly what Housel digs into with the example of low-income lottery ticket buyers. For them, the lottery is a tangible dream, a way to achieve a better life that seems out of reach otherwise.
It really makes you realize that understanding different perspectives is key to making sound financial choices. It's about empathy, right? Recognizing that what might seem illogical to one person makes sense to another because of their experience.
Absolutely. Housel then goes on to discuss the danger of what he calls the illusion of control.
Thinking we have more control over our money than we really do, I feel like we've all been there.
Right. And he uses a fascinating example. Rajat Gupta, a wildly successful businessman who went to prison for insider trading. Afterward, Gupta said, "Don't get too attached to anything, your reputation, your accomplishments, or any of it."
Wow. Coming from someone who had it all and lost it, that's pretty powerful.
It really highlights how fleeting success can be and the importance of valuing things money can't buy, like reputation or relationships. It's about knowing when you have enough.
Enough is such a tricky concept, especially in a world that's always telling us we need more.
It really is. Housel reminds us that contentment isn't about hitting some arbitrary number. It's about aligning your financial decisions with your values and finding fulfillment beyond material possessions.
Okay, so chasing more isn't the answer, but what about building wealth? I know Housel is a big believer in the power of compounding.
He is, and he has a really interesting way of explaining it. He compares it to the formation of ice ages.
Ice ages. That doesn't sound very financial.
It's all about small changes over time leading to massive results. Just like a little bit of leftover snow can over millennia trigger a massive ice age, small, consistent investments can lead to incredible wealth over the long term.
Like a financial snowball effect.
Exactly. He uses Warren Buffett as the ultimate example. Almost all of his wealth comes from starting early and staying invested for decades. He even contrasts Buffett with Jim Simons, who had much higher annual returns but started investing later in life.
So even with lower returns, starting early and staying invested can lead to greater wealth. That's kind of mind-blowing.
It really highlights the importance of time and patience in building wealth.
So we're thinking long-term, but what about the less glamorous side of things? Housel emphasizes survival, right? Making the money is one thing, but keeping it is another.
He does, and he reminds us that survival is key in the long game of finance. You can have the best plans, but you need to account for unexpected events. Like think about 2008, the dot-com bubble, or even the COVID-19 pandemic. These events can derail even the most carefully laid plans.
So how do we plan for the unpredictable? Do we just throw our hands up in defeat?
Not at all. Housel says it's about building in room for error. Michael Moritz, head of Sequoia Capital, put it well. We've always been afraid of going out of business. We assume that tomorrow won't be like yesterday. We can't afford to rest on our laurels.
So it's like having a financial cushion to absorb those unexpected hits. Does that mean keeping a big chunk of cash, even though it might seem irrational?
It can. Sometimes making the reasonable choice is better than the strictly rational one. Housel challenges the idea that we're always rational actors. We're driven by emotions, Remember Julius Wagner-Jarek?
Refresh my memory.
He won a Nobel Prize for treating syphilis by inducing fevers. Totally irrational, right? But it worked. It's rarely used today because fevers are so unpleasant.
So, sometimes what makes sense on paper isn't the best choice because it can cause emotional distress that you just can't sustain. I'm starting to see the connection to investing. Sticking with a plan through volatility, even if it feels scary, could be the reasonable choice, even if it's not perfectly rational.
That's a great insight. It's about finding an approach that you can stick with for the long haul, something that aligns with your emotional well-being and doesn't make you want to bail at the first sign of trouble.
All right, so we've got long-term thinking, room for error, and acknowledging we're not spreadsheets. What else does Housel have up his sleeve?
Well, he tackles this tricky question. How much should we rely on history to guide our financial decisions?
That's a good one. Things change so fast. Look how much the world has evolved, even in just the past few decades.
Exactly. Housel points out the historians as prophets fallacy. The future rarely perfectly mirrors the past, especially in finance where things are always changing. Remember when Bill Gates thought a gigabyte of storage was overkill?
That's hilarious. We carry terabytes around in our pockets now. Imagine trying to run a startup today the way it was done decades ago. It wouldn't work.
Precisely. The financial world is constantly evolving. And Housel also points out the allure and danger of pessimism.
Pessimism is so seductive, especially in the face of uncertainty. It almost sounds more intelligent to be pessimistic. Like in 2008, when people predicted the U.S. would break up into 6 pieces because of economic turmoil.
And yet here we are, still one nation, facing new challenges but also experiencing growth and progress. Housel reminds us that while we should acknowledge risks, letting pessimism rule our financial decisions can lead to missed opportunities and unnecessary anxiety.
It's about finding that balance between being realistic and not letting fear paralyze us.
Exactly. And as we start to wrap up this part of our deep dive, Housel leaves us with one more thought. The importance of managing expectations, especially when comparing ourselves to others. Our financial desires are often driven by these social comparisons, which can set us up for disappointment. It's like driving a Ferrari. The admiration might not be for the driver, but for the car itself.
That is a really good analogy. So instead of chasing external validation, we should be defining our own version of success, one that aligns with our values and goals.
Absolutely. It's about finding that internal sense of contentment rather than constantly striving for what someone else has. It's so easy to get caught in the comparison trap, especially with social media constantly showcasing everyone else's highlight reels. But Housel wants us to shift our focus to what he calls invisible wealth.
Invisible wealth, what's that all about? Sounds mysterious.
It's the wealth we don't see, the savings we accumulate, the investments we make, the financial security we build over time.
But it's not about the flashy stuff, but the peace of mind that comes from knowing you're financially secure.
Exactly. Housel argues that true wealth is about having options, the freedom to make choices, to pursue your passions, and to weather those unexpected storms without being financially crippled.
It's like having a financial safety net so you can live life on your own terms. Which brings us to saving. It's not always the most exciting topic, but Housel makes a compelling case for it.
He does. He argues that saving isn't just about reaching a specific goal, like a down payment or retirement, but about creating a buffer for life's surprises.
Think of it like building a shock absorber for your life. You never know when you're going to hit a bump in the road.
That's a great analogy. He also challenges the idea that you need a specific reason to save. Saving for the sake of saving, building that financial resilience and freedom can be just as important.
It's about not constantly stressing about money and having the flexibility to make choices as life unfolds.
And this is where Housel's insights into the psychology of money are so valuable. He gets that saving isn't just about numbers, it's about understanding our own behaviors and what motivates us.
We're not always rational, are we? Sometimes our emotions lead us to make financial decisions that aren't in our best interest. Like, treat yourself is a great philosophy until it becomes an everyday habit that sabotages your savings goals.
Exactly. And there's the trap Housel calls ego and income. Our spending tends to inflate with our income, even if our needs and values haven't changed. It's that classic keeping up with the Joneses scenario.
You get a raise, and suddenly you need a fancier car or a bigger house, even if you were perfectly happy before. I think we've all felt that pressure at some point. But going back to enough, how do you define that?
Housel says it's about aligning your spending with your values, not with what everyone else is doing or what society tells you to want.
Find that sweet spot where you're comfortable and not always striving for more, so you can actually enjoy the wealth you've built. So it's about freedom and control, right? Not being tied to a job you hate just to maintain a certain lifestyle.
Yes. Housel says that real wealth is having control over your time and your options. The freedom to pursue work you love, spend time with loved ones, and design a life that brings you meaning.
It's such an empowering message. So how do we get there? How do we build that financial independence and gain control over our time?
While Housel's big on the long game, he emphasizes taking a long-term perspective.
Building wealth is a marathon, not a sprint.
Exactly. It's about consistently saving and investing, even when things get volatile or when you're tempted by those get-rich-quick schemes.
Ride out those market fluctuations, knowing that over time, things tend to even out.
Right. Have a plan, but be prepared for it to change. Life throws curveballs. No financial plan survives first contact with reality. It's about being flexible and adaptable.
And remembering that investing isn't just about numbers, it's also about human behavior, managing emotions, and recognizing the roles luck and risk play.
Absolutely. Make peace with the fact that you can't control everything and that sometimes things just don't go your way. Learn from your mistakes and keep moving forward.
Speaking of learning, Housel dives into the limitations of historical data when it comes to predicting the future.
He's very clear that the financial world is constantly changing. What worked in the past might not work today. He uses venture capital as an example. It was practically non-existent a few decades ago, and the way startups are funded today is completely different.
So using historical data about startup success rates from decades ago might not be so relevant in today's rapidly changing tech environment.
Not necessarily. He also cautions against blindly following even the most successful investors. What worked for them in their specific time and context might not work for you. Even Benjamin Graham, Warren Buffett's mentor and the father of value investing, admitted that his famous approach of analyzing individual stocks wasn't as effective as it once was.
Wow. If Benjamin Graham himself acknowledged his methods needed to adapt, that says a lot. So it's about recognizing that finance is dynamic and there's no one-size-fits-all approach to building wealth.
Absolutely. And on that note, Housel also explores the seductive nature of pessimism, especially when it comes to money.
Pessimism often sounds so intelligent, especially when the media loves to focus on negative news and hype up economic downturns.
It plays into our fears and anxieties. But Housel reminds us that progress is often slow and steady, while setbacks tend to be sudden and dramatic. This makes it easier to build a narrative around pessimism, even when the long-term trends are positive. Think about the dot-com bubble bursting. It felt like the end of the world, but in hindsight, it was just a blip on the radar of long-term economic growth.
Sometimes things turn out better than expected. It's all about finding that balance between acknowledging risks and maintaining perspective.
Exactly. And that leads us to another important point: embracing change.
Life is full of twists and turns. Our goals, desires, and circumstances change constantly. It's about recognizing that we're not static beings, and our financial plans need to reflect that.
He cautions against making extreme financial decisions that might lock us into a lifestyle or career path that no longer serves us.
It's about making choices that align with our values and goals at each stage of our lives, and recognizing that what works for one person might not work for another. We're allowed to change our minds. What we wanted at 20 might not be what we want at 40.
Right. He gives this analogy of a young boy who dreams of being a tractor driver, but realizes as he grows that his passions and aspirations have changed.
So our financial decisions should support the life we want, not dictate it.
Exactly. And that means being willing to let go of things we've already invested in, even if it feels like a loss, and embracing the uncertainty that comes with change. It's about having the courage to course correct and create a life that truly reflects who we are and what we value.
I love that. Housel's book challenges us to think differently about money and success. It's about aligning our financial decisions with our values, about finding contentment and fulfillment in a world that's constantly pushing us to want more.
He encourages us to be more aware of our behaviors, recognize the psychological barriers to reaching our financial goals, and develop strategies that help us navigate this complex world of money.
It's a journey, not a destination, right? We're all works in progress. Speaking of journeys, this brings us to one of the most compelling parts of Housel's book, his exploration of risk and how it can both empower and sabotage our financial decisions.
Risk is everywhere in finance, and Housel argues that how we perceive and manage it is often more important than our actual financial knowledge.
So it's less about what we know and more about how we handle the unknowns. Okay, I'm ready to dive in. How does he suggest we approach risk?
He starts by highlighting the role of luck and randomness. He reminds us that we can't control everything, that things just happen, and our outcomes aren't always a reflection of our skill.
Sometimes it's just being in the right place at the right time.
Exactly. Take Bill Gates, for example, one of the wealthiest people in the world. Yes, he's brilliant and hardworking, but a lot of his success came from luck, being in the right place at the right time with the right idea and capitalizing on fortunate circumstances.
So it's about acknowledging this element of luck, both when we judge our own successes and the successes of others.
Right. Recognize that randomness exists. Our outcomes aren't entirely in our control, but that doesn't mean we should give up.
It just means being realistic and not thinking we can predict and control everything.
Exactly. Which brings us to the illusion of control, that tendency to overestimate our ability to influence outcomes. This can be dangerous, especially when it comes to investing.
We often feel like we have more control over our investments than we really do.
That's right. Housel uses the story of Jesse Livermore, a legendary stock trader who made and lost multiple fortunes. He was brilliant, but even he couldn't predict the market. He ended up taking his own life, overwhelmed by his losses.
It's a tragic reminder that even the most talented investors can fall victim to the illusion of control and the dangers of taking on too much risk.
That's why Housel says managing risk isn't about eliminating it, but about building in that margin of safety, a buffer to absorb setbacks.
Have a plan, but be prepared for it to go sideways.
Think of it like being a blackjack card counter. Card counting tilts the odds, but even the best card counters can't win every hand.
They build in a cushion to withstand those inevitable losing streaks. So we should do the same with our finances.
Exactly. Make informed decisions, have a plan, but recognize you can't predict everything. Build in that room for error, that buffer, to protect yourself from the unexpected.
It's about finding that balance between taking calculated risks and protecting yourself from financial ruin. Speaking of balance, Housel also warns against making extreme financial decisions. Why is that?
He says extreme choices increase the odds of regret later on as our lives change.
So if you choose to live super frugally to retire early, you might later regret missing out on experiences or opportunities that were important to you. Or if you work crazy hours for a high income, you might regret neglecting your health or relationships.
Exactly. He encourages finding balance, making choices aligned with your values at each stage of your life, and recognizing that there's no one right way to do things. What works for someone else might not work for you.
It's about finding that sweet spot where you're comfortable, not constantly striving for more, and able to enjoy the journey as much as the destination. I'm sensing a theme here.
Housel is all about finding that middle ground, that balance between extremes.
He gives us a framework for understanding our own behaviors, our motivations, and those often invisible forces that shape our financial decisions. He's encouraging us to be more mindful, more intentional, and more aligned with our values.
And reminding us that financial well-being isn't just about money, it's about creating a life that's rich with meaning, purpose, and fulfillment.
You know, one of the things that really stuck with me from the psychology of money is Housel's discussion of the end of history illusion.
That's a fascinating concept. What is the end of history illusion again?
It's that idea that we tend to think who we are today is who we'll always be. We forget how much we've changed over time and assume our goals, values, and desires will stay the same.
We hit a point in life and think, this is it, I've got it all figured out. But as Housel points out, life rarely works that way. Things are constantly in flux. What we want, including our financial goals, is likely to change over time.
So how does this illusion trip us up when it comes to money?
Well, it can lead us to make decisions that feel right now, but that we might regret down the road. Like choosing a career solely for earning potential. Years later, you might realize you're miserable, even with a big paycheck.
Or making huge financial sacrifices for something like early retirement, only to realize your priorities have shifted. Maybe you now value travel or time with family more than a big nest egg.
Exactly. Housel encourages us to be flexible, to recognize that our financial plans need to adapt as we do. We need to avoid decisions that lock us into a path that might not serve us in the future.
Don't get so stuck on your plan that you miss the detours. Your life is going to change. Your money plan needs to be able to keep up.
That's a great way to put it. It's about being open to change, being willing to adjust course, and realizing that there's no single right way to manage your money.
And this ties into House's point about the danger of sunk costs.
Those investments of time, money, or effort that we can't recover, they can really hold us back from making good financial decisions, especially when we're clinging to a plan that's no longer working.
It's that feeling of, I've put so much into this, I can't give up now. even when deep down you know you should.
Housel says sometimes the best thing is to walk away, acknowledge the mistake, and move on. Sometimes cutting your losses is the most valuable thing you can do to free yourself from the burden of past decisions.
So how do we actually apply all of this wisdom to our own lives? It's one thing to talk about it, but how do we actually change our behavior?
Well, we can start by being more aware of our tendencies, recognizing when we're clinging to that end of history illusion or falling into the sunk cost trap.
So we should regularly ask ourselves, are my goals still aligned with my values and priorities? Or am I sticking with this plan just because I've already invested so much? Good questions to ponder. What else can we do?
We can also build more flexibility into our financial plans.
Instead of rigid rules, create a framework that allows for adjustments as life throws curveballs.
Yeah.
Savings rate, investment strategy, even our careers. These can all evolve as we do.
And sometimes the biggest change is simply letting go of the past.
Acknowledge that we're all works in progress. We're constantly learning and growing. It's okay to make mistakes, to change our minds, and to adapt as we go.
Housel's insights are just a few of the many gems he shares in The Psychology of Money. It's a book packed with practical wisdom and a refreshing perspective on what it means to be financially well.
So as we wrap up this deep dive, what are some key takeaways for our listeners? What are some actionable steps they can take to improve their financial lives?
I think the biggest takeaway is that building wealth is more about behavior than intelligence or market savvy. It's about developing habits and mindsets that lead to consistent saving, long-term investing, and a healthy relationship with risk.
It's about recognizing that our emotions play a huge role in our financial decisions and learning to manage them so they don't lead us astray.
Absolutely. It's about finding that contentment and fulfillment that go beyond material things. True wealth is about having control over your time, your choices, and your life, not just about a number in your bank account.
It's about using money as a tool to build the life you want, a life rich in meaning, purpose, and joy.
And it's about remembering that the journey to financial independence is a marathon, not a sprint. There will be challenges, but by embracing Housel's principles, you can navigate those challenges and build a future that is both financially secure and deeply fulfilling.
This has been an incredible deep dive. I feel like we've all gained some valuable insights from the psychology of money. Thank you so much for joining us on this journey. Until next time, keep exploring, keep learning, and keep striving to build a life that is both financially sound and deeply fulfilling.